big picture. So we start with address history, right? And then we move into work history. Work history, I would say, is number one as far as the rules that we have to follow per Fannie Mae, Freddie Mac.
Yeah.
You had mentioned earlier 2-year work history. Very important.
Yeah.
There are so many rules around how long you've been on your job, how many jobs you've had in a 2-year period, what your pay looks like, whether you're hourly or salary, or roofers, they get piece rate, things like that. Knowing your income and how you are paid is very important.
Today, I have a very, very special guest with us here. And I want to introduce everyone to Amy Cockburn. Amy has been working with me now for 9 years, since February 1st of 2015.
Yep.
Not only have you been working with me, but I've known you since you were a very, very little child. And you have also known me because you are my sister and I am your brother.
Yeah.
And I'm very, very, very lucky to have you here working with me and with us.
Thank you.
Yeah,
Likewise.
for sure.
Yeah.
So I wanted to have you come on and talk about, because you are very, very good at what you do. Extremely good. And you want to explain what you do, or I can explain I'll explain what you kind of do, and then you can kind of maybe elaborate on that.
Yep.
So what Amy, you're an originator.
Yep.
What that means, she's also a loan officer.
Yep.
But you also handle a lot of the paperwork, a lot of the disclosures, and a lot of the attention to detail that is required for a borrower to get to that end point.
Yeah.
And so your brain is wired in that way, and to where you can really pay attention to all of the paperwork and also help that client along.
Yeah.
And so that's been primarily your role, is to watch the documents to help the borrowers get from when they go into contract to when they close.
Yeah.
Did I get
to
that
the
right?
closing table. Yeah.
Yeah.
Yep.
Anything else you want to say there?
No, not really. People might know, as far as language-wise, you like it to be called, like my position as
Oh,
loan
right.
partner, right?
Yeah.
But a lot of people might understand that position as a transaction coordinator.
Yeah.
So they go hand in hand. Most people understand what like a transaction coordinator would be.
Yeah, transaction coordinator. You're
Yeah.
coordinating and managing that loan
Yeah.
all the way to
Yeah.
its end.
Yeah.
Making sure that customer has a good experience.
Correct.
And so the reason why I wanted to have you on is because you're really good at making sure the customer has a good experience.
Yes.
So we wanted to talk about, and I wanted to have you talk about, what makes that buyer actually have a good experience. Like,
Yeah.
what happens? What is what is that borrower's role in having a good experience on their mortgage? Not every borrower is going to be able to experience us to work for them for their loan.
Yeah.
And so whoever's watching this may pick up some pointers on what they can do to make sure they have a really good experience on
Yeah.
their mortgage.
Absolutely.
Yeah.
Yeah.
So the first things I wanted to cover is, so you've actually worked for me for 9 years.
Yeah.
February 1st, you've been with me. You started as a front desk person.
Yep.
And then you've been in this role for how many years have you been?
Well, so I started out as front desk, and then you kind of moved me into a pre-approval stage.
That's right,
So
yeah.
before even a contract, so I was chasing documentation
Yeah.
before you even found a house. And then from there, I kind of moved into the loan partner transaction coordinator role.
Yeah.
So I would say it's been at least, I don't know, 7 of those 8
Yeah.
years. Yeah.
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 Awesome. So you have a ton of experience on what you do, but also what is required from the borrower. So this is
Correct.
this is the juice that I want to get to.
Yeah.
The meat of this episode is defining exactly what the borrower can do to have a good experience with their loan officer.
Yeah.
So we wrote a couple things down that we can talk about. The first one is, a lot of borrowers, not everyone's the same, right? So
Right.
everyone has their very unique You know,
I would go so far as to say every client, every borrower, every family is different. There's something different on every transaction.
Yeah.
I would go so far as to say that, yeah.
Yeah. So in the very beginning, let's say you have a customer that's never bought a home before. We help a lot of first-time home buyers.
Yes.
What would be some pointers you would give that first-time home buyer on starting the process before they even get pre-approved, or what would be some of your recommendations for that?
As a first-time home buyer, I mean, first steps, I know a lot of times they get in touch with a real estate agent first, which we say this all the time, most buyers fall in love with the home before they fall in love with the loan, right?
Right.
First step is always going to be meeting with a loan officer or calling a loan officer and just having that initial conversation. Because I'm getting your basic information. And a lot of customers ask me, well, do you need to pull my credit right away? Do you need to do all this? And the answer to that is not necessarily. That first initial conversation, I want to know what your goals are. And so just thinking about what your goals are before you're having that conversation. When do you want to buy? How soon? Things like that. That's super important to kind of have in mind before that conversation.
I love that, because you're right. A lot of families, a lot of borrowers, when they have no idea where it starts, what to do. A lot of them think, oh, the first thing I do is go and apply, and that's not really. We don't. That's not the goal. The goal is to find out what this customer is wanting.
Yeah.
Right?
Yep. And whether you're looking to purchase, right now, 3 months, 6 months, a year, it is super important to actually have a sit down with a loan officer. Just so you know what the next steps are.
Yeah.
So once you have an idea of, if you want to purchase in a year, and then you go and sit down with you or I, or doesn't matter, we're going to be able to provide you with those steps.
I think a lot of customers, like on my end too, they don't realize like the payment. This is a big question. Like, hey, Pete, what's my payment?
Huge. Yeah.
So like they might have this house that they love, like what you're saying. They fall in love with the house, and then the payment comes second in mind. What's the payment? But what you're saying, what I heard you say is, you should know your payment first.
Yes.
Before you are looking at properties.
Know what your comfortable range is. Yeah.
And you don't have to pull credit to know what your payment is. They can just give us a call, right? Give you a call and go over exactly, hey, what's my payment at this range, or what's my payment at that range?
Yeah.
Yeah. So what I heard you say is, like, for sure, figuring out and the plan for them personally, and talking to the loan officer first before the realtor.
Yes.
Got it.
Yep.
And what happens next, or what?
Once we take that call from you, we are just going through basic information. So having an idea of, we ask about your address history. It's huge, right? Yeah. Some people, they've stayed at their address more than 2 years, but we have to get a full 2-year address history. So if you've moved, some people I've seen up to 10 times, we need all of those addresses.
Yeah.
And by we, I don't mean us, Vaughn Mortgage. It's actually a rule that we have to follow to get your full address history.
Got it. And who makes that rule?
FHA, Fannie Mae, Freddie Mac makes that rule.
Got it. So what I heard you say is that customer family that's gonna be seeing how much they can qualify for. They have, part of what they have to provide is a 2-year work history.
Address history.
Sorry, address history.
Yeah.
Yes.
Yep.
2-year address history.
Yeah.
And sometimes the customer has been moving, and that's okay too, right?
Oh yeah, you can move as many times as you want. We just basically, as far as the history, we have to be able to document and show, where you've lived.
Yeah.
Yeah.
Part of what I'm sure, and I know you do too, but I'll explain to the customer. There's 3 basic things. I'm going to say 2 basic things. We need to show stability.
Yeah.
So that's in the past.
Yeah.
And then we also need to show ability going forward in the future.
Yep.
You show stability. So my old CEO that I worked for 9 years told me this, or taught me this.
Right.
Stability and ability. So the address of where someone lives is showing some sort of stability.
Yes.
they could still move
Yeah.
and lived at different places. It doesn't mean they're not stable, but
Correct.
it does help us start to paint a picture.
Yes.
So do you want to talk about the picture of the big bird's eye view of that?
As far as address history
Or just the big picture, bird's eye view of a customer or of a family that's wanting to get a mortgage. What
Yeah.
what's the big picture?
The big picture is as far as information I'm getting from them. Is that what you're asking?
Yeah.
Big picture. So we start with address history, right? And then we move into work history. Work history, I would say, is number one as far as the rules that we have to follow per Fannie Mae, Freddie Mac.
Yeah.
You had mentioned earlier a 2-year work history. Very, very important.
Yeah.
There are so many rules around how long you've been on your job, how many jobs you've had in a 2-year period, what your pay looks like, whether you're hourly or salary, or, roofers, they get piece rate, things like that. So knowing your income and how you are paid is very, very important.
And what are some of the things that a customer can provide or give their loan officer information-wise to help that process?
Yeah. So I always tell my customer a pay stub, your most recent pay stub at least, and then your W-2 from the prior year. Now, that's just basic. There is more information that we require, but as far as getting the ball rolling, having a pay stub and a W-2 from the last year.
Got it.
Yeah.
Yeah, and I think you're right. That is the most important. One of the most important is the job, the work history, because that's where the income's coming in.
Correct.
And to give our audience kind of a backstory of why that is so important is because they're going to lend this money out for a long period of time.
Yes.
Yeah.
Well, and you've taught me this. It's like each transaction that you have, it's almost like thinking about it if it was your own personal funds that you were lending someone, right?
Yeah.
And would you lend someone money
For that long
of a period and that much with this story and this job history and this pay? Yeah.
I was also taught that from somebody else as well.
Yeah.
I mean, when you're a customer and you're applying for a mortgage, I don't want to scare people away.
Yeah.
But this call is really to really help with that process. Make sure that customer is being honest with her.
Yeah.
And actually does know their work history. There's many customers over the last 2 years.
Yeah.
They come and we start asking, and they might not remember, and that's okay.
Yep.
It's just this is an important detail that we need to get for that pre-approval process.
Yeah. And I was actually talking to a client yesterday, and she had said that she had talked to multiple different lenders that, she just didn't know with her job history and what was allowed and not allowed. And she said no one had ever told her, one way or the other. And I just really helped educate her on, how long she needed to be on her job and things like that.
Yeah.
And she really appreciated that.
Yeah.
So that's also a part of, you don't know what you don't know as a buyer, especially a first-time home buyer. I always tell clients that you just don't know. You don't do this every day like we do.
Yeah.
And we're the ones that are supposed to supply you with the tools in order to take the steps to get there.
And I think a lot of customers or families that come in, they might be scared.
Yeah.
And they might not want to potentially disclose things that they may potentially think that it's a bad thing if they disclose it.
Yeah.
Do you want to talk about that at all? Or as far as like, what are your thoughts on that? If a customer coming in, they have something that's maybe they had this job that they quit, or maybe they had this job or maybe they had this job gap.
Yeah. We've had clients, that, when we're getting that information from you over the phone and we're looking at your history and you tell me, I've been on my job 3 years. And then we go to do the verification, with your pay stubs and W-2s. And for whatever reason, the income isn't lining up with how long you've been on your job.
Yeah.
And so come to find out from the employer, you had taken 6 months off. Maybe you got hurt on the job or something happened. Totally fine.
Yeah.
Those are just the things that we need to know.
So what I heard you say is that just tell us because we'll help you.
Yes.
Like we're on that customer's side.
Yeah.
We want to get them the loan.
Yeah.
And I think a lot of customers don't understand that piece of it, that we actually are on their side wanting to help them.
We're all on the same team.
Yeah, but we also know the rules. Right?
Yeah.
We know the rules really good. And so the more honest that customer, from what I'm hearing you say, is the more honest that customer can be about everything as it relates to the application.
Yep.
The better we'll be able to help them.
Yes.
And the better experience they'll be able to have.
Yes.
I've had multiple times in my career where that's happened, and we don't find this information out until way farther in on the process. And it's okay because 99% of the time we get it fixed.
Right.
We figure it out and we're able to get it fixed. Like I had a customer, they were moving from Southern California. They were moving up to Redding. And when that happens in that situation, you know this.
Yeah.
But when they're moving, we have to have their job. We have to figure out, okay, are they going to keep their job down there? Or are they going to have a job up here? Or are they going to be able to work remotely? Because it's an 8-hour drive down to Southern California, and they're buying as a primary residence. And so part of my job is to make sure that if they're buying as a primary, will they be able to still have the income?
Right.
Otherwise, if they're moving here as a primary, they're working down there in Southern California, and they might not be able to afford this home if I give them the loan, if we give them the loan. And so this is something that we have to make sure. Well, this particular customer, was not exactly aware that they didn't realize they were not going to keep their job. Or sorry, they were keeping their job down there. One of them was keeping their job down there. One of them was moving up here and getting a job up here. We ended up figuring it out, but I didn't have this information, or I wasn't told. I was originally told that they were going to keep their jobs and it was going to be okay for them to work remotely up here. Yeah. Anyways, long story short, we figured it out. We got it done for them, but it did cause a little bit of a delay. Not necessarily, and it wasn't like us that was upset about it or anything like that, but just for that customer's experience on their end. We want to make sure that they have the least amount of stress as possible.
Correct. Yeah.
Right?
Yep. Yeah, and talking about primary residence, I think it would be cool. Like, what's the definition of a primary residence?
Oh, great question. So there's 3 ways you can buy a home. A lot of customers don't know this, but a primary residence, the definition is that you live in the home just 51% of the time. Yeah. So you could literally have another place, and when we say a home, it doesn't mean that you own a home. Like you could rent a place and buy a place as a primary. You just have to buy it. You just have to live there 51% of the time, according to Fannie Mae, Freddie Mac, Ginnie Mae. 51% of the time, and then you could live in the rental the other 49% of the time. Yep. Yeah. There's 3 ways you can buy a house. You can buy a primary residence, you can buy a second home, or you can buy an investment property. If you buy a primary residence and you're going to live in the home, you have to live there 51% of the time. If you buy a second home, this is a second home that you cannot use rental income to help you qualify for that home. Yep. Now, you could be renting, right? And that's your primary residence, and you could buy what's called a second home. It's not really a second home. It's a second residence, right? Yeah. Then there's third one is investment property. You can buy now when you buy an investment property, you can use the rental income to help you qualify.
Yes. Yeah.
Yeah. Yeah. Now, there's differences on how much down payment there is, you know. But you know, a lot of people don't understand the 3 different ways to buy a home.
A home. Yep. Yeah.
Yeah. So what else would you say that will help buyers, clients be able to have a really good experience? What other topics would you say? I know we talked a little bit about documentation, and then we talked a little bit about maybe loan options. This is a big topic, knowing their loan options. Yeah. You want to talk about that?
Yeah. So one of the things that we do when we meet with clients is we go over a mortgage cost analysis. As far as a mortgage cost analysis, we give you multiple options and pathways become a homeowner in different loans, right?
Yeah.
So for the customer, we want to make sure that you understand those options, but also know that it's okay if you choose one option and then we get a week, 2 weeks into escrow and you change your mind and you want to change. You absolutely can make that change. However, communication on that change is crucial as far as making sure we're providing you with a good experience and the least amount of stress as possible.
So what I heard you say was that the customer should know that they always have options.
Yes.
They always have. They can, it's just not one loan that you can get qualified for. There's multiple different ways you can structure a loan.
Yeah.
Multiple different loans that you can get. Each one has their benefits. Each one has their drawbacks. And our job is to present those options and then help you make a choice.
Yeah.
But what you're saying is that they pick an option and then they just communicate to us that they may want to switch to this option.
Yeah. Yep. Yeah. Or change things, like you could put more down payment down or less down payment or those are the things that, as far as communicating with not only your loan officer but the team, as far as
The
making
team of that loan officer.
correct. Yeah.
The processor, the transaction coordinator.
Yeah. Exactly.
Yeah, just communicating.
Communication.
Yeah, a lot of people think when they go into contract that they're stuck with that option.
Yeah.
But I do tell customers that they can switch.
Yes. Yeah.
I need to do a better job in telling them to communicate that to us.
Yes.
When they do want to make that switch.
Yeah.
Yeah.
Yeah. A big thing too, I mean, just in regards to that too, a part of what we have to do when you go into contract, and this is just getting started on the process, right? Yeah. So we send initial disclosures. So I get a lot of questions. Well, what are the initial disclosures? Yeah. So the disclosure piece of it is basically everything we have to disclose to the customer up front as far as the loan terms, and then all federal disclosures, things that, basically tell you about the loan and different things that the state and Fed require. Yeah. Yeah. So
this is a good topic. I'm glad we brought up disclosures.
Yeah. So a big question that I get is, when you sign those initial disclosures, they're called initial for a reason. Mm-hmm. So by you signing those disclosures, it doesn't mean you're locked into anything, and it doesn't mean any of the information on there can't be changed. Mm-hmm. So I always explain, it's at that point that you're reviewing those disclosures. Yes, please review your initial disclosures. Some customers don't. Make sure that any information on those disclosures, because it's the application's on there, right, with all of your information we get from you up front, making sure all of that is correct, because it's at that point to let us know any changes that need to be made, and we can 100% make those changes.
Got it.
That doesn't mean you can't sign those initial disclosures. Yeah. It just means that we're able to make the correct changes after those disclosures are signed, so by the time you go to the closing table, everything is correct. Yeah. Yeah.
So there's a few things that I heard you say.
Yeah.
The first one is that I heard you say is on the disclosures, it doesn't mean that they just sign their life away.
Correct.
In other words, they're not obligated.
Correct.
So when someone signs their disclosures, are they obligated to finish that loan?
No.
Do they get penalized if they back out of the loan?
There are things that no, I would say, but yes, at the same time, part of what's in the disclosure package is an intent to proceed. Mm-hmm. So an intent to proceed is needed in order for an appraisal to be completed, right? Mm-hmm. Yep. And so if the appraisal gets done and you want to cancel after the appraisal is completed, this is where you still have to and are obligated to pay that appraiser. Yeah.
And I know some offices or some loan officers, they'll actually have the customer pay for the appraisal before the order. We have a different process. We actually don't make you pay for the appraisal. We actually pay it when we close. Yeah. Because the appraisal will get paid when it's closed. But what you're saying is that if they proceed and we do order the appraisal, of course we have to pay the appraiser. But they're not locked into any kind of contract or anything. They could still back out of the loan.
Correct.
And even if they did get the appraisal, they could still back out of the loan. They could decide not to buy the property.
Correct.
They could decide to switch loan terms. They could decide to pay cash for the house. Yep. They could do all of the above. Yeah. Yep. So then why the initial disclosures? What are they really signing?
They're acknowledging, I would say, that they're understanding the terms that the loan officer went over and are acknowledging the loan that they're applying for the loan.
Yeah.
Yeah.
Yeah, that's good. This was a huge change that the feds did on compliance, because a lot of people back before 2008, when there was all these crazy loans that were being done, people were getting to the closing table and they had no idea. It was like playing telephone. Like, you start telling someone something and it goes all the way around, and by the time it gets back, it's like completely different something that they're getting at their closing table.
Yeah.
So what the initial disclosures are is that communicating, hey, this is what we're starting with.
Yeah.
And then those disclosures can't change. In other words, it's more for us because we are obligated to make sure that we disclose upfront what's being charged.
Yep.
And that we cannot charge more than what that disclosure is, and unless it's like something that's can change. But our costs and the title costs, they can't change because we're disclosing it by the time it gets to closing. In other words, we can't arbitrarily increase
Correct.
the cost.
Yeah.
For the final. This is what the disclosures.
Yeah.
Did I say that right?
Yeah. And that's where we get into the compliance aspect of it, because once you have a actual application and a triggered application, we
What does
also
that mean, trigger? What does trigger
There's
mean?
5 pieces of information that trigger an application. You're gonna test me on this.
Yeah.
This is a part of
5
our.
or 6. I think it's 6.
I think it's 5. Is it
5.
6?
Okay, maybe it's. Let's hear it.
So, name, right?
Yeah.
Yep.
name.
Social Security. You have to have a property address. Appraised value, or is it estimated value?
I think an address.
I did say address.
You said address. Okay. Well, we might get back to you on the 5 pieces of information. We'll put it on the screen here.
Yeah.
So the 5 pieces of information: is address, social security number, name.
Yeah.
That's 3.
I believe it's estimated value of the
value.
home.
Yeah, value of the home. I think you're right. The value.
Yeah.
And what's the 5th one?
Income.
We need income.
Or is it credit?
Credit. Yeah, credit. Yeah, it is credit. Yeah.
Credit. Yeah.
So there's like so many. I think the income is the 6th piece.
Okay.
Yeah. To know the income,
Yeah.
right? Once there's 6 pieces. Okay. So that once you have that 6 pieces of information, you are obligated as a lender.
Correct.
To do what?
To disclose to the client within 3 days the terms of that loan.
Got it.
Yeah.
So those terms doesn't mean they're obligated to.
Correct.
It just means that it's more basically protecting the customer, saying, "Hey, this is what we're charging."
Yep.
And then those costs cannot change by the time it gets to
Correct.
close. Is that right?
Yeah. Certain costs, not all of them.
Yeah.
But yeah.
Yeah. If the insurance cost goes up.
Correct.
It's their homeowner's insurance. Hey, this is where the homeowner's insurance started, but then we got some more quotes and maybe it got better or maybe it got worse potentially.
So the customer has every opportunity to shop for their own homeowner's insurance.
Yeah.
So anything that you can shop for per the estimate can change because they have an opportunity to shop for. Yeah.
See, this is a great topic because, the disclosures are a piece, I understand where the customer is coming from because they see all these documents and it's like 100 pages of things that they have to sign. And it's like page after page of all this stuff. And, who knows, they have to like read everything, to see. And this is where a lot of trust can come in.
Yeah.
Right.
Yeah.
So you want to talk about trust, like that customer trusting the loan officer and making sure there is a lot of trust there.
Yeah. Obviously, trust in any relationship is crucial, not just in the mortgage world, relationship world too. But trusting, I would say, it's not me. I definitely, like, if I could give a loan for free, I probably would, but wouldn't at the same time. Yeah. Like, I want to be able to provide and help customers purchase a home first. That's the first thing I would say. Yeah. As far as, we understand the disclosures. If you're reviewing those disclosures, most crucial piece to review is the loan estimate. And that's where I say that they need to trust us.
Yes, go ahead.
But we also need to trust them.
Correct.
as far as they need to do their due diligence in reviewing the documentation.
Correct.
As well.
That's a great point, because there could be some things that need to be communicated to us, like, hey, I noticed that you didn't put this property that I own.
Yes.
I told you that we own this property, but I didn't see the property that we own in Maine or in Texas or something like that.
Yeah.
Making sure all the assets and liabilities are on the application is important.
Correct. Yeah. And that's a part of the disclosures that you sign too, that, hey, to my knowledge, there's not any other loan or liabilities that aren't listed on this application.
And do they get penalized if they signed it and it, somehow there is another property?
No, they don't get penalized. If you forgot, I mean, there's so much that goes into it that it won't. Yeah.
Yes, and that's what I say too. However, customers should know that if they don't put something on the application, there's 99.9% chance that we do find it.
Yes,
correct?
Correct.
So there's reports and there's things that the Fannie Mae, Freddie Mac have in place to be able to know if you own a property or not.
Correct.
Know if your name is on another loan or not.
Yeah.
That maybe not showing up on a credit report.
Yeah.
Part of the documentation is we see the bank statements.
Correct.
And so we can see expenses coming out of the bank statement.
Yes.
So, for example, if you have an IRS expense that doesn't show up on credit, it doesn't show up on anything else, but it shows that you're making payments to the IRS.
Yeah.
For sure, that would be something that the underwriter will ask, hey, what is this IRS expense that you have?
And that's like part of the questions that we ask in that initial conversation. One of the declaration questions we do ask is, do you
part of the application?
Do you owe any taxes or anything like that? A lot of people, I don't think that they connect that question with, oh yeah, actually I'm paying the IRS X amount of dollars.
And it's okay if they forget. That's not a big deal. The goal here is to make sure that they have a good experience.
Correct.
We want them to have a really good experience, and we're going to do everything we can.
Yeah.
But also the customer should also play their part.
Correct. Yeah. The trust on both sides. Yeah.
No, that was a super good topic. Okay, what else do we got here? Understanding the numbers. So we did talk a little bit about that.
Yeah.
One thing I do want to say about that is, the mortgage in and of itself can be very complicated. In other words, there's interest rates, there's APRs, it's 30-year term. There's so much jargon there, and there's so many different closing costs, and loan amount and all. There's so many things to look at. This is where the trust comes in. What I was going to say is, if there's at any point you don't understand anything, no question is a bad question.
Yeah,
right?
Agreed. Yeah,
because that question could lead to that customer having a better experience.
Yeah.
I've had customers where, like I just was talking to a customer about a reverse mortgage. And I don't know what that customer's thinking, and they don't know what they don't know, but I don't know what they, are thinking or have questions on. Right. So like I told them, it's like, hey, the reverse mortgage is not for everybody, but it does serve its purpose, and potentially it might work well for you. I told them the number one thing is it's very expensive. Reverse mortgage is very expensive, right?
Yeah.
And so I told him what the cost was, and I didn't realize he equated that cost to him having to pay out of the pocket. And so I didn't know that.
Yeah.
And so he was like telling me he didn't want to do the loan, and we were going over other details, and finally a half hour into the conversation, he goes, so those closing costs, that when do you expect payment on that? And I said, oh no, that comes out of the loan. That's in the loan documents.
Yeah.
And so that was an example of just making sure that you fully understand and not have any assumptions, because I don't know what those assumptions are.
Yep.
And sometimes it's hard for me to say every little detail because there are a lot of details of the mortgage.
Yeah, that's good.
And so anyways, he once he knew that he didn't have to pay, he's all in on the reverse mortgage. He's like, oh yeah, let's go. We're ready to go. Let's do this.
Yeah. Another really good topic is credit.
Yes.
Credit
Yes,
is
let's talk about that.
huge.
Yeah.
It's a everyday situation. I will use that word.
This is where every customer is different.
Yes, every customer is different with credit, and a big thing. So we can get into, as far as the questions I get a lot of times when I'm talking to first-time home buyers. Do you need a credit score when you buy a home?
Yeah, you do.
You do.
Yes. Yeah.
Yeah. So
They'll see online that they don't, but they truly do. I've never heard of someone getting a loan, Fannie Mae, Freddie Mac,
Correct.
Ginnie Mae, without a credit score.
Yes. So, and to those clients, I always say, yes, we definitely need you to get a credit score. That is step number one. And a big thing with that too is it's almost better that you don't have a credit score or any credit cards or auto loans or things like that than it is if you're on the other side to where you have dug yourself a hole and have lower credit scores.
Yeah.
It's easier to get a credit score and start off on the right foot as opposed to digging yourself out of the hole.
Because I feel like this is a super important topic.
Yeah.
The reason why is because a lot of people might have good credit, 640. I think that's decent credit. But they think it's horrible, so they'll never apply for a mortgage.
Yeah.
Right? Some people think that they should do certain things to their credit before they actually apply.
Yeah.
And because, they might think, oh, I need to do this, this, and this before I talk to the mortgage person.
Yeah.
Because I want to, get a better deal, and they're going to, give me a higher rate or something like that.
Yeah.
So it's exact opposite of what they should do. Because the loan officer is going to help them.
Yeah.
The loan officer is going to tell them, hey, before we actually give you the loan, pay this credit card off or pay it down by this much.
Yeah.
We'll maximize that score. Do you
Yeah.
want to talk about that a little bit?
Yeah. More so, I have like stories in mind of clients that, it's either hasn't worked or it has worked. I have a client that, I gave him the instructions. So a lot of times with the credit scores, if you have revolving credit, meaning a credit card that has a limit that you can borrow up to that
What's
limit.
the difference between revolving and closed?
A revolving credit card as opposed to an installment loan.
Okay.
It's better to have revolving than installment.
What does revolving mean, though?
Revolving means you have a limit on that credit card, and you can utilize that limit up and down. You can utilize it, pay it off.
Versus like a car loan where you pay it off every month. You pay it off and it goes down. You don't have availability.
Correct.
Okay, sorry, go ahead.
So as far as the credit bureaus are concerned, they look at installment debt as
Which is like a car loan.
Correct. As your debt. So by paying that, it won't necessarily help your credit. By getting an auto loan, it won't necessarily help your credit.
Yep.
A revolving credit card will help your credit. And the longer you have that revolving credit card and keeping the balance under 30% will help your credit.
So what I just heard you say, Amy, is that some people think, oh, I should get this car because it's going to help my credit.
Correct.
So because it's one loan and that they have to pay it back, and if they don't pay it back, they get penalized, it doesn't really help the credit score.
Correct.
Now, over time, it could help by having 12, 24 months, but that's far down the road.
Correct.
But a credit card, from what you're saying, is they open that credit card, they have available credit, that helps their credit.
Yeah.
Faster than a car loan.
Yeah, because the credit bureaus are able to see how you manage your money. Right? So having, they see if you're utilizing it, if you're maxing it out, which you never want to max out a credit card, right?
Right.
You want to keep your balance under 30% or pay it off every month.
Got it.
But you also want to utilize it.
Yeah.
Right? You don't
want to use it.
Yeah, you don't want to just have it.
We could create a whole 10 topics podcast for 10 hours and talking about credit. There's so much to learn, guys, on credit. This is why having trust in your loan officer and loan officer team really comes in handy, because the loan officer is going to really know credit.
Yeah.
Especially if they've been around and they've seen a lot of loans. Not necessarily being in the business a long time, but seen a lot of loans, because that's where the experience comes in. We can really understand credit and really help that customer.
Yeah.
Would you say that?
Oh, yeah, absolutely.
Yeah. There was one more thing I was going to say. Oh, Yeah, so like, the credit card thing, a lot of people don't want to have credit cards. They
Yeah.
think that credit cards are bad and they don't
Correct.
want to have credit cards. So they don't have any credit cards at all, but they might have this car loan. Well, I always explain, this is my last thing I want to talk about with credit. I explain it like this. Like what you were saying in the beginning, if you give your money to somebody, do you want to give your money to someone that has a credit card but has a zero balance and they can borrow up to $1,000 but it's zero balance? Or would you rather loan to someone that doesn't have any credit cards at all and no ability to get on credit? To me, that answer is I'd rather lend to the person that has an available credit on their credit card that they're not utilizing or not using. This is why I tell everyone not to close their credit cards.
Yes,
Keep their
that's
credit cards
huge.
open. Never
Yes.
close a credit card,
Yeah.
ever.
Yes.
That can hurt your credit.
Correct.
The more available credit that there is, the
Yeah.
better your score can be.
Yep.
Yeah.
Yeah. That's huge. And that's what my client, I had told him to pay down two credit cards, which he did, but he had gotten an account closed and didn't tell me that he was planning on doing that, nor did I tell him to not do
To
that.
not do it. Yeah.
But I didn't know that was,
So what you're saying is that he closed the account, it hurt his credit.
Yeah.
You didn't know he was going to do that.
correct.
Nor did you say not to do that
Correct.
because there's,
So many things that,
hey, don't jump off the cliff,
Yes.
you may die. Right?
correct.
I didn't think about saying that.
Yeah.
But that's what,
Yeah.
not that that's, that's a little bit sarcastic, but
Right.
but what you're saying is there's so many things, so communicate.
Correct.
Hey, I'm going to
Yeah.
do this. If you do anything with your credit,
Yeah.
say something.
Yeah.
Say, hey, is it okay if I close this?
Yeah.
Or, hey, is it okay if I pay this balance?
Yeah.
Or, hey, is it okay if I buy this T-shirt with this credit card? Right?
Yeah. Yeah. Which, I mean, that in itself gets us into, like, if we're talking about being an escrow, right?
Yeah.
Things not to do when you're an escrow.
That'll be on our next episode, so be sure to stay tuned to episode 2
Yeah.
of me and Amy
Yep.
talking about
What
really
not
good-
to do.
Yeah, what not to do and really good borrowers.
Yeah.
So Amy, we've been talking for a long time. It feels like it's only been a couple minutes,
Yeah.
and you're super, super knowledgeable about this whole, process. So thank you very much. Any last words or any last advice that you would say for a first-time home buyer?
Yeah. Number 1, talk to a loan officer first. Number 2, be prompt.
Prompt, yes.
Anytime we ask for anything documentation wise, any of it, the sooner you can get it to us, the better experience for not only you, but for us as well.
Yeah.
Yeah.
Yeah. And there's always a reason for that on requesting that documentation.
Always.
And it's not necessarily us saying, hey, this is what we need. It's we're just following the rules,
Yeah.
right?
I don't
Whatever-
want to have to request 15 things from you,
Yeah.
but I have to follow the rules and providing you with those rules and what we need in order to fulfill. Yeah.
So what you're saying is to have a really good experience, be prompt,
Yes.
provide the documentation.
Yes.
Don't ask questions. Just give it. No, I'm just kidding. You can ask
You
questions.
can yeah.
We'll explain it to you.
Yeah.
Documentation, be prompt, and talk to a loan officer first
Yes.
before talking to the realtor.
Yeah.
Love it.
Yeah.
Thank you, Amy.
Yep.
Super awesome
Thanks,
having you.
Pete.